One of my long-standing positions is in the shipping industry and a top-performing company, ZIM Integrated Shipping Services. But with the industry going through a cyclical trend right now, with recession fears driving down stocks, ZIM has been pummeled 35% year to date. With their Q2 earnings out, here's an update on the company and what action I'm taking with my investment. The last couple of years saw a massive boom in the shipping industry. With the global pandemic driving down production, we saw massive product and labour shortages, delays and increased demand from China. As businesses struggled to bring their products to market and avoid empty shelves, supplies became more valuable, and as shipping rates increased, they were willing to pay up to continue operations. When ships could offload their cargo, we saw clogged up ports and a reduced workforce of dock workers and lorry drivers required to deliver the goods, creating further delay and high demand. Shipping rates have always been volatile, as with such a major industry, there are only about 5,500 cargo ships in the world, representing 25 million TEUs, and the trips can be extensive. Cargo from China can take 4 to 6 weeks to the US depending on which coastline, and 25 to 35 days to the UK, so customers order ahead of time to ensure they have their products on the shelves when needed. The high demand, low supply situation created vast opportunity for shipping companies who could charge higher rates for their limited capacity, and we saw massive growth in stock prices, with ZIM in particular climbing to $91 within 14 months of their $12 IPO last January, representing a 660% growth. The tide has since turned, and with the stock falling 60% from its high and 35% down year to date, it begs the question on whether they are still a good investment. Although port congestion remains a problem, as the backlog is being worked through, retailers now find themselves overstocked, having ordered far above what they need and are now having to make major price cuts to clear their warehouses. It doesn't put them in a good position to order more products, and that gives reason for a possible slowdown in the shipping industry. But looking over the earnings, it's likely that change in sentiment may have been overblown. Here's the details. If you needed a reason to sell it on single earnings, then Q2 certainly gave you that. The $3.4 billion revenue is 7.74% down from their Q1 revenue, and net income of $1.3 billion is down by 21.99%. But year on year, we are looking at a 43.93% increase in revenue and a 50.39% increase in net income, which is still amazing growth. Assets have taken a dip, cash is down lower than Q4, and long-term debt is up. So on the surface, it seems like a bad quarter after 2021 saw such amazing growth, with their earnings per share jumping 784% from $4 to $39, and it's expected this trend to continue in 2022. So with Q2 earnings of $11.07 missing the expected 12.84 by 13.78%, shareholders have mutinied very quickly. But if we review company performance, there has been some shifting of the zones they work with, but the overall TEU volume hasn't suffered, and their charter rates remain stable. Data from the US National Retail Federation shows that freight demand remains high, and although freight rates have come down slightly, ZIMs are still considerably higher than they were a year ago, with Q2 rates 54% higher than the same time last year. With ZIM's market cap at $4.93 billion, their $1.3 billion net income is just over 26% earned back within a single quarter. There aren't many companies towing their weight like that, and ZIM's outlook for the future remains strong. ZIM have reaffirmed their guidance with the expectation of record earnings and profits for 2022, and they expect to make full use of new builds planned for delivery over the next 2 years, which includes 28 modern LNG-fueled vessels, adding over 399,000 TEUs of additional capacity. With their asset-light business model generating an indecent amount of cash, the company board declared a revised dividend policy, planning a payout of 30% each quarter and a catch-up at the end of the fiscal year. In Q2, they declared $571 million, or $4.75 per share, reflecting 30% of second quarter 2022 net income, plus a one-time catch-up of 10% of the first quarter net income. With the stock trading short of $37, that's a yield of over 51%, and with how well the company is doing in raising cash, I'm confident we can see another special dividend at the end of the fiscal year, which is great news to investors who love a dividend. ZIM seems to be a victim of the overall change in market sentiment, where the performance in 2021 has given the false impression that this would continue in 2022 at the same pace. So as recession fears are weighed in, missing high expectations in Q2 has, in my opinion, caused the market to overreact and the stock has been oversold. As much as growth has slowed in 2022 and may continue to do so in the second half, the data suggests it could still be a highly profitable year for the company. ZIM has a foundation of a good business, generating enough cash to cover its market cap within a year. The industry might be cyclical and expected to see a downturn, but ZIM's current profitability doesn't present much risk to investors. With so much cash being given back to investors with a very generous dividend, there's a high incentive to stay with the stock. The dividends I've received so far have so far cancelled out the drop in the stock price. But be warned, with ZIM favouring high dividend payments instead of stock buybacks, shareholders have not stayed the course and have made a habit of cutting and running on ex-dividend dates, especially last year's special, so be prepared for rough seas ahead around dividend dates. Reviewing the current fundamentals of the business, trade that ridiculous 0.79 times earnings, 0.36 times sales and 0.94 times book, I think the company is still trading cheap and the sell-off has gone far ahead of where the company is financially. I think ZIM remains a stock holding in my portfolio and I'll be taking advantage of big dips in the market to buy more. I wouldn't throw new money into the market right now as it goes through a general downturn over recession fears, but the stock is still an attractive entry point and I will be reinvesting the dividend back into the company, growing my position across the fiscal year in time for a large catch-up dividend, which I think is just as likely as last year. That's my take, and as always, if you have any thoughts, please comment below and let me know, and if you like what you see and you want to see more, smash that like button and subscribe. Until next time.